All right, we'll cut it short at that point because the much-awaited banking license guidelines are on its way. And let's go straight across to our banking editor, George Cherian, for all the details on that one. George, over to you.
Thanks, Nisha. So we have the final guidelines for new bank licenses put out by the RBI just now. What it says is that eligible promoters will comprise groups in the private sector, entities in the public sector, and non-banking financial companies. They will be eligible to set up a bank. So essentially this is a climb down from the RBI's earlier stance that companies with with interests in the real estate space or the construction space or in the broking space will not be allowed licenses, and this is something that the finance ministry was pushing for. So it's a huge climb down on the part of the Reserve Bank of India on that front. So that, apart from that, there haven't been very many changes really made by the RBI. This is early details that we have. So what it is saying is it's the non-operative holding company will have to be set up by the promoters, which will have to be 100% owned by the promoters. The NOHC, or the non-operative holding company, will have to hold a minimum of 40% of the paid up capital of the bank that it sets up. So this is again no change from the earlier draft guideline recommendation that the RBI had put out. Also, the promoters' shareholdings, as per the draft guidelines, was recommended in a staggered manner, where from 40% they would come down to 20% in 10 years' time, and then down to 15% in 12 years' time. Here, in the final guideline, what they've said is that the promoter shareholding will have to come down from 40% to 15% in 12 years. So they haven't put in that 10-year 20% clause. It goes straight down to 15% within 12 years. Foreign shareholding in the bank should not exceed 49% for the first 5 years. That's something that the RBI has put out in the final guidelines, and after which foreign shareholding in the bank will be as per the ruling FDI policy in banks at that particular point in time. Also, at least 50% of the directors on the board of the bank will have to be independent directors. This is again something that was suggested in the draft guidelines. 25% of the bank's branch network will have to be in unbanked rural centers. They've defined unbanked rural centers as centers with a population of up to 9,999. So essentially, places with a population of less than 10,000. The bank will comply with priority sector rulings, all of that. So, okay, so this is what we have as of now. I'm going to take it across to Anirudh, who may possibly have more details than I have. Anirudh, to you.
Certainly, George, as you mentioned, the biggest thing, of course, is the fact that they've climbed down from that particular ruling of not allowing real estate and broking companies to apply for the banking license. And of course, a number of fit and proper guidelines are going to be put in place. As you mentioned, we have only the primary press release at this point of time, and they've actually said that 25% of the new bank branches will have to be in rural and unbanked areas. So of course, that's one thing which promoters will have to keep in mind, the fact that they'll have to ensure that the financial inclusion benefits are maintained. Also, of course, the fact that they have to maintain close to 50% of their directors as independent directors is another key thing. The other thing, of course, as you mentioned, is the fact that the non-operative holding company will have to be set up by any entity that sets up for this banking license, and of course that is something which will have to be listed in due course. Also, of course, they put out a procedure for giving out these licenses. There is going to be a time period between which whoever is interested for these licenses will have to apply to the RBI. These licenses will then be screened by a high-level committee, including the government as well as the RBI, following which the committee is going to put in those recommendations to the RBI, which will then issue an in-principle approval to all of the entities that it feels is fit and proper. of course, that decision will lie wholly and solely with the Reserve Bank of India. Following that, that in principle approval is going to be given for 1 year, and that, of course, is going to be taken forward as far as setting up the bank is concerned. At this point of time, there aren't very many details as to how many entities are going to be allowed to finally set up the bank, or whether there are going to be any particular entities which are going to be shown favor over the others. But clearly, the slant of the guidelines do seem to be suggesting that the RBI wants entities that are more interested in setting up a financially inclusive bank, and banks that are more that are going to be going further in terms of improving the presence of the banking network in the country.
All right, Anirudh, we'll come back to you in just a bit, but we've got Ashwin Parekh, who's National Leader for Global Financial Services at Ernst & Young, joining us on the phone line. Ashwin, we have the final guidelines out, not very much different from the draft guidelines, but the big climb down, it seems, on the part of the Reserve Bank of India is that it has not said that companies with an interest or with revenues of more than 10% from either construction, real estate or broking cannot apply for a banking license. So that seems to be a big climb down, under pressure possibly by the Finance Ministry. What would your initial reactions to the final guidelines be?
Yeah, see, I mean, my submission would be that, we will certainly have a situation where there will be a lot of aspirants, there will be a lot of people, who may wish to now apply for the banking license. Earlier, of course, the interest was there, but now on account of this particular climb down, even people who have a large presence in real estate or in the broking business can also apply. So can therefore, to that extent now, the regulator will have to, or the committee that the regulator will form, will have to really evaluate the applications, in terms of any contagion risk that, the presence of these people in speculative business can bring about. So that perhaps the filter or the filtration of the applications will perhaps take place at that stage. I'm not certainly expecting 150 or 200 people to get licensed. And so to that extent, that part of the evaluation will now be done once, let's say, people have applied in keeping with the guidelines.
Sure, but Ashwin, the last time around, which was nearly 20 years back, when the first round of licenses were given for private sector banks, the number of applications even at that time were fairly large, given the progress that the economy had made at that juncture. This time around, there are various numbers being thrown around. There is a view that you will have a minimum of 100 to 150 applications going to the Reserve Bank of India. Not necessarily that many licenses will be issued, but 100 to 150 applications, is that a reasonable number for us to be talking about?
It would be a very reasonable number because, the reason is very simple. To begin with, what will happen is, the earlier two guidelines, since they did not allow the business houses to apply, so to that extent, even when we had 150 or plus kind of applications last time, well, when I say last time, we were talking about 1992, when the first time it was opened up, we can certainly look at a much larger number of applications this time around, because a lot of entrepreneurs have grown to a size where the minimum capital they may be able to put up, they may have their own plans, in going into smaller markets, they may have their own plans in regards to banking. So, from the aspiration point of view, I would say it's difficult to draw a line, George. So.
Right. Also, Ashwin, in the draft guidelines, one of the points listed out by the Reserve Bank of India was that the bank will have to be listed within 2 years. I'm trying to find something on that front, but that's the final note seems to be silent on that front. Would you say that that's actually a good idea on the part of the RBI, because for a new bank to list within 2 years is a bit of a challenge?
Yeah, see, there are two parts to this entire aspect. One is whether the promoters would really be able to, take their equity to the market, and will they get the kind of price for all the effort that they put in. That's one aspect. The second aspect is, unless some element of some clarity, either in the guidelines itself or the new set of regulations that will follow, I suppose unless there is some clarity in regards what is the time frame over which they are supposed to do that. Now, last time, for example, I mean, we all know that the conditions which were associated with the approval talked about the period over which the promoters were expected or required to dilute their equity. In the absence of guidelines, and in the absence of the enabling powers, it was difficult for the RBI really require the promoters to dilute their equity. In that sense, I would say the challenge will continue. I mean, in the sense, if there is no clarity right at the guideline stage or at the regulation stage, then how soon would the promoters be expected to dilute their equity, or can they really continue with their equity as long as they wish to, is something that will have to be now examined, George.
Ashwin, also in the final guidelines, what the RBI is also saying is that the NOFHC and the bank are not to have any exposure to the promoter group. Also, the bank cannot invest in equity or debt capital instruments of any financial entities held by the NOFC. Would you say that this is a little stringent, because earlier the expectation was that the bank would not be allowed to do that, not the NOFC? So would you say that this is actually a sound decision on the part of the RBI? And again, does this in any manner disincentivize a number of corporates to enter banking now?
No, a very sound. I mean, this is at the best the minimum requirement. At best is the minimum requirement that can really happen, on this particular part. Because otherwise, we will perhaps go back to the same reasons why, the nationalization of the banking companies had to be carried out earlier.
Right. Ashwin, stay on with us. We've also got Shinjini Kumar, who's director at PricewaterhouseCoopers, joining us on the phone line. Shinjini, 25% of branches of the new bank will have to be in unbanked rural centers with a population of less than 10,000. Can this prove to be a disincentive?
It depends on how you are looking at it and what's the kind of business strategy you have. India has largely proved to be an economy of small ticket size and large volumes. Now, it depends upon the strategy that the new players bring to the table, and if they are successful in bringing a strategy that can be a game changer, then we are going to see a very different type of banking, and it will be very similar to the kind of difference that the last round of private sector banks created in the banking sector. However, given that the economy continues to perform at every level and there is enough incentive to make money at the large ticket size level, creating that strategy may not be a very immediate, idea that people may have come out with.
Sure. So then how easy is it going to be for these banks to put in place a strategy such as that? Because you'd agree that if you have maybe 4 to 5 licenses issued, these 4 to 5 banks will have to go out and seek the best possible talent available. Talent comes at a price. And then when you need to create a cost structure that makes it feasible to operate in these unbanked rural centers, you're talking about cost structure, or the ability of the bank to reward getting that much, restrained to some extent. How easy is it going to be then?
No, it's not easy, but I'll definitely say that it takes a little bit of a disruptive strategy to create that kind of a game-changing model. You're not going to be able to create the same kind of bank that you already have in the system. So we are not going to have more of the same. And if we do, then the RBI guidelines will actually prevent it. What is interesting there is to see how we ensure the level playing field, because as regulator, that's one of the primary tasks. So if there is a stringent condition on the new licensees and not for the existing licenses, then the level playing field is something which is a matter of concern. But if it's purely driven from their own strategic imperative, then maybe it's an idea that's timely and maybe it will work.
Sure. Okay, so Shinjini, I'm just going to come back to you. And Ashwin, I want to ask you that same question, because I'm asking you this question in context of what foreign banks have tried and failed at, in terms of, they're being forced to take up licenses in smaller centers, most of them not being able to make much headway in that space and having to actually throw up their hands and say that this is not a game we are capable of playing.
Yeah.
In such a scenario, are we talking about these new banks having a smaller bank, so to speak, within the larger bank in order to, create separate cost structures that can address those unbanked rural centers and make it feasible to operate in those centers?
No, I mean, see, there is one thing which is getting clearly established, and that is the dynamic aspect about this guideline would be perhaps that people will have to start looking at those points, where the income generation and the saving generation is high and where the banking density is not there. So, quite clearly we're talking about a different kind of banking altogether. Now, there are two parts to that new banking. One is, the liability creation or the deposit taking. But more significantly, the challenge will also be on finding good assets in those markets. What kind of assets are you going to build? What kind of banking are you going to do if your branches are going to be mainly focused in smaller markets and in rural markets? And to that extent, we may perhaps see a different kind of banking. Quite clearly, all those aspirants, who've been looking at the banking licenses with a sense of eagerness, may have to really go back to their drawing boards, may have to really look at their plans and look at exactly a way in which they can make this new kind of banking also viable on one side, and B is what are the new methods that they can bring into this new kind of banking that we're talking about.
Well, Ashwin, I'm going to come back to you in just a minute, but we've got Sachindra Nath of Religare Enterprises joining us on the phone line from Delhi. Sachindra, would you say that this is something that you'd have ideally liked to see? And we've been talking to Ashwin Parekh about the whole thing that the new banks will have to set up at least 25% of their branch network in smaller towns, and they've defined smaller towns as centers with a population of 10,000 and less. Is it going to be easy?
Yeah, so I have not looked at the guideline. I've been in the car for the last 1 hour or so. So I'm also trying to gather what has come out. But what I'm listening while being on the call, I think so one important aspect is that Reserve Bank has this time not excluded anyone, including public sector bank, and all those criteria of real estate and all that have gone out. So I think so this would be a true test of fit and proper, and people who can really take the government and the bank's agenda of financial inclusion forward. And if you take that, so I think so from that perspective, this is really, really remarkable that everyone who can show capability, have delivered that in past, have experience of running a large business like a bank, would be able to show their strength and would qualify. Now it's up to the judgment of the committee to decide whether they are capable of doing that or not. With respect to this 25% branches has to be in those areas, my view is very simple. This is the requirement for which the licenses are being given. Inclusion is an important agenda for the central bank as well as for the government. If you desire to be a bank, you have to structure your business model accordingly. It's not a question of whether this is right or wrong. It is a question of that's the requirement, and there are proven models on which you can run sustainable business by having your branches in such areas.
Sure. So, simple question: is Religare going to apply for a license?
I think so that in my mind, there have never been a doubt that we would apply for banking license. The reason have been fairly simple. I think so we have built one of the finest diversified financial services business in India. We have experience of managing businesses across multiple verticals. We service SMEs, and I think so it is natural for us to progress and have banking under our fold, because that we will be able to service our customer across the board very well. So we will surely try and put our best foot forward.
Right. Also, Ashwin, just coming back to you, one of the criteria laid down by the RBI is, of course, the fact that the majority of directors on the bank board will have to be independent directors. But in a country like India, how independent are independent directors? That's the big question from a governance front that everyone will want to ask.
Well, no, I don't think that is from the good governance point of view, this requirement is very essential to my mind. Now, when we say independence, what we really do mean is, a large body of professionals on one side, a large body of, let's say, people who are not going to be associated with or interested in either the borrowing and lending aspect of the bank on one side, and be not directly or indirectly connected with any interest, that may perhaps bring in any kind of risk into the banking. all along, I mean, even if you look at the subsidiarization discussion paper that had come out, the regulator has maintained, that the good quality of board is very essential. I mean, a high order, to bring about a high order of governance, and independent directors, I mean, majority, so more than 50% of the directors should be independent is an important aspect. George, I do believe, that if you're going to dilute some of your other requirements, particularly, let's say, requirements around real estate business or broking business, for instance, the only thing you can gain, I mean, from the regulator's point of view, can really rely upon. So we're talking of two things. One is a good presence of independent directors, but also that these directors will have a much larger responsibility, to my mind, to make sure that all the objectives with which the license is being granted is actually being executed, is actually being delivered by the bank. George?
Right. Ashwin, we also have Mr. D.K. Mittal joining us on the phone line. Mr. Mittal, the government seems to have had its way. They've ensured that the RBI does not, in a manner, discriminate against corporate entities with interest in real estate, construction or broking. But should it have been this way? Because the RBI had reason enough to insist that these corporates with these kind of interests be kept out.
No, I don't think, let me clarify, there's no question of having a way through, because it was always a very consultative process. And there's no question of, we decided, both of us decided together, that's my understanding. Secondly, we are a capital starved country. Yeah, how many entities would have that kind of capital which we are looking at to be put into banking system? And thirdly, there could be good entities in each category, there could be bad entities. So should we be looking at the entity's background, or should we be looking at the type of business they are doing into? So I think these were the discussions held between the government and the RBI, and I think we have come to some understanding, which is a fairly good understanding. RBI is the ultimate decision maker, who to give a license, who not to give a license, and they would look at the background of the promoters, they would look at their credentials, their pedigree, and then only they will decide.
Right. And Mr. Mittal, this is one of the issues we've been talking of. How easy is it going to be for these banks to actually create a workable model, to the extent that the guidelines insist that 25% of the network, branch network, be in unbanked rural centers with populations of less than 10,000?
See, these are the challenges which they have to understand from day one, that if you want to do banking, how you want to go about it. But please understand that if there are NBFCs which are operating very well, if they come up and convert themselves into holding company, for them to start business becomes much faster. So you would have all kinds of models coming through, where there is no holding company and I want to set up a holding company afresh. They have different challenges. I have an existing company, the NBFC, so to say. I want to convert it to holding company and have a license. That's a different thing, because I will be transferring some of the business of the NBFC to also, which is the banking business, to the bank. So you would have different challenges of different entities which would apply for a license and would get a license.
But and another issue, Mr. Mittal, just to understand this better, allowing 49% FDI in these new banks that are set up, which the RBI has said after 5 years will then comply with the extent policy at that time. If you could just explain this for us a little better for our understanding.
Initially, the understanding was that we should have Indian entities coming up and setting up banks. After that, because up to 74% equity can be invested by foreigners or foreign entities in banking. So that RBI was right in saying that up to 49% we should permit, and that's a fair thing to do.
All right. And also the insistence of the RBI that the bank or the NOHC not be allowed to lend to promoter group companies. Do you believe that is going to work as a disincentive for some of the corporate houses to come forward and apply for bank licenses? Because for many of them, this was one of the incentives for them to come into this space.
I think that's very correct from corporate governance point of view. I am holding two hats. I take public money and lend to my corporates, and then there's no accountability. How will that happen? That cannot happen, because banks hold public money. Promoters' money is hardly anything there. A bank having 30,000 crore deposit may have a shareholders' funds of only 2,000 crores. Rest may be the net worth, the profits which are used as reserves. So it is unfair to permit these banks which are promoted by entities, private entities, that they can lend to corporates either by way of debt or they can invest into the entities of these corporates or these promoters by way of equity. That's not possible. Why should that be done?
Right. Also, Mr. Mittal, one other point that the RBI had mentioned in the draft guidelines was that corporate houses applying for licenses and getting that license will not be allowed to use the corporate name. So if the Tatas apply for a bank license and they get that license, they can't call it the Tata Bank or any other name using the Tata brand. The final guidelines seem to be silent on that. So what should one make of it?
No, I think that is a detailing to be done, because if any group has stake in a bank, which is up to 40%, they can have, or whatever numbers have been permitted by RBI. Certainly, it is the promoter by whose name the client will come. That's a fact. So I think it's for RBI to take a view as to what are the positive and negative side of it. But using a name or not using a name, to us, it does not matter, because ultimately any bank which will come up by a group will always be selling the name of that group. And the credentials of that will be known to everybody, and then they will decide whether they want to do banking with this bank or not.
Right, absolutely. So that was one of the big reservations that many of the corporate houses had. They said that why should we come into the banking space if we're not allowed to use the brand that we've built over so many years? But the RBI was adamant that they do not want this to happen.
I don't think it's there in the part of the final guidelines. Man.
So can one assume that they will be allowed to use the brand?
I won't say that for the regulator, but it is not a part of prohibition in the final guidelines.
All right. Okay, Mr. Mittal, thanks very much for joining us on the show and to actually helping us understand these final guidelines put out by the RBI, by the Reserve Bank of India a little better. Ashwin, just coming back to you with that same point on corporate houses being allowed to use their brand when they name the bank once they do get their licenses. Would you be in favor of that?
Well, actually, this is something which is very interesting, George. Several clients, with whom we are working very closely on the new banking initiatives, we've had an opportunity of addressing this question. George, my submission is that Basel III requires, under Pillar 2, banks to set aside a substantial amount of, let's say, capital arising out of reputation risk. Now, there is a merit in lending your name in terms of lending a certain amount of reputation and name behind the bank. But at the same time, let me also assure you, George, that name is not going to come to the bank without a cost. You see, because what will then happen is that anything that can go in that brand name, anything that can go adverse will also have an impact on the bank. So it can work both ways. So that's something that people in the past, for example, you will recognize, even when we weren't talking about reputation risk as much as we do today, or we weren't talking, if you look at all the banks before they were nationalized, most of the business houses who were instrumental in putting those banks together did not lend their names to those banks, So it works both ways, George. There is no simple answer to that, to my mind, but in some form or the other, having anything in rigid terms, either by way of regulations not allowing or may not have worked. So I think the best thing that the regulator has perhaps done is kept silent on in the new guidelines, basically.
But would you have been in favor of it, Ashwin?
Well, yes, to the extent that, let me articulate my point. If we're talking about some 2, 3, 4 very large, very reputed business houses, I would say that their interest and their commitment to the deposit holders would perhaps be far more greater. In terms of really respecting that liability, really honoring that liability, should any difficulty in any one of the business cycles may arise on account of any economic cyclical condition. So to that extent, I would say there is a substantial merit. It gives a lot of comfort to the deposit holders, very clearly. But at the same time, let's not forget, that crisis and economic cycles happen, most sectors today are very vulnerable to that. Now, if there is any concentration risk in any of the business house, if I'm in commodities, for instance, or if I'm in steel, or if I'm in something or the other, and if I'm facing an adverse condition, an economic condition at a given point in time, it may have a very adverse impact on my deposit holders' comfort, on their minds, basically. So it really came, I mean, George, quite clearly, I take the point that people will have larger comfort with very large names who have very diversified businesses, and we are sure that their risks in other activities will not be brought to the banking companies. But for the others, where there is an element of concentration of risk, things aren't too clear, I should say.
Right. Ashwin, I know we're all getting very excited about the final guidelines on new bank licenses, and applicants have 4 months to apply for those licenses. But realistically speaking, how many licenses should we expect will finally be handed out? Because the last time around we saw something similar happening.
Well, I mean, I would say that the kind of banking that we are now going to talk about, with 25% branches in the rural areas, for instance, I mean, and there's nothing difficult about this requirement, George, because all along, in case of all the branch expansion in the last 5 years, we have seen that RBI has really required banking companies to go to those markets, the smaller markets. So there's nothing peculiarly different in this guideline about it. But one thing I must mention, it will certainly take any bank, any new bank, anywhere between 3 to 4 years, to really find roots on one side, they become profitable, they become meaningful, and start contributing to the economy. In such a scenario, I mean, I don't think neither the economy nor the regulator can afford too many people experimenting all at the same time, trying out different things and some of them failing. I mean, the issue is, I mean, with every 100 rupees of liability that a bank has, only 8 or 9 rupees is capital, the balance is deposit holders' money. So, I mean, banking, as I say, is an opportunity, but it's a huge responsibility as well. I've always maintained that. And to that extent, if too many people get the license, then the ability, on the part of the promoters on one side to make it a meaningful venture, and the regulator to keep a keen eye on that venture for a longer period, does become a bit of a challenge, George.
Right. Ashwin, I'm going to come back to you in just a minute, but we've also got Hemendra Hazare of Nirmal Bang Securities joining us on the phone line. Now, Hemendra, if you ask banks, existing banks, they tell you that there are too many banks in India, we don't need so many banks. If you ask, bank license hopefuls, they say that there are too few banks in India, that we need more banks. Which side are you on?
It all depends where you need more banks. You see, you need more banks in rural India, which obviously no one really wants to venture into. Because even if you see the history of the new private sector banks, even after nearly 2 decades of operations, a very small, minuscule share of their total credit and deposits comes from rural India. So it is very clear that left to themselves, they would just love to be only in the metropolitan urban centers, because that's where the business is. So that is why, RBI, thankfully has brought in this condition of 25% of branches have to be in unbanked rural centers. And that is why you've supposedly allowed the banking sector to open up.
Right. But, Hemendra, with the guidelines, in the manner they've been put out, these are the final guidelines, 25% of the network needing to be in rural centers. Would you say that a lot of applicants will just go away when they see this and not actually apply for those licenses?
I would just like to clarify, it should be, I think, in unbanked rural centers.
Yeah, unbanked rural centers, that's right.
That makes a big difference, because you can be in very profitable rural centers which either border metros, or you can be where very big mandis are there. Now, the way out of this is you set up a very token, like a 1 or 2 man branch in an unbanked rural center. But with that, you will be able to set up some branches rather in, profitable urban metro or centers. And that's where you will generate the bulk of your business. If they had really wanted to be very stringent about these norms, they should have said a certain percentage of deposits and a certain percentage of credit must be earmarked for rural India, because the national average is about 10%. While if you see some of the new private sector banks, their business from rural India will be close to about 1%. So this is the way they will get, they will bypass this norm. They will set up, 3-man branches in unbanked rural centers, and they will have very full staffed branches in metro and urban centers.
Right. So wouldn't it be rather challenging for them on the cost front in order to actually make this business workable?
So definitely there would be an additional to their cost, but this is the way you will do it. You will, see that the cost structure of your branches in unbanked rural centers will be kept to a minimum, and that's why your rent and your labor is the major cost, and technology. So by keeping just the bare minimum staff, you'll try to bring down that cost as much as possible.
Right. Let Hemendra stay on with us, but we just spoke to Deepak Parekh, chairman of HDFC, a short while ago, who believes that the RBI guidelines that have been put out are sensible and realistic, and he has said that he understands the rationale on the part of the RBI for keeping bank license norms precautionary. He says that he is welcoming the RBI's move to not bar any entity from applying for a license, and he's also said that the RBI's final norms for bank licenses have been well thought through. Ashwin, back to you on the the foreign holding norm that the RBI has mentioned, saying that it will be capped at 49%. The Finance Ministry was pushing for a slightly higher level than this.
Well, actually, you see, the past experience shows, that if you take a foreign investor, a strategic foreign investor for that, as your partner in a banking venture, we have had one or two examples in the past when in 1992 when the licenses were offered, the reaction was a mixed one. They were to play a certain role in Indian banking, but after a certain stage they stopped playing it. And then in one case the foreign shareholder almost sold his equity, sold it out to once again Indian investors. So, it's been a little mixed one. But this time around, I thought that if you're talking about large capital sums, and if we're talking about a certain order of risk, because all said and done, inclusive banking or banking around inclusion, financial inclusion, has its own risk. It's not a viable business as yet, and therefore, I thought some amount of risk capital, some amount of equity could have been, more amount of equity could have been drawn from those foreign investors who are eager to do both the things. One is they're eager to really put in the investments in India into a banking venture such as this, but they can also bring about some amount of know-how along with their capital. If they are working in, those kind of markets where inclusion is a challenge, then in that case, it could have been a little more welcome. But all said and done, from all the new initiatives that I have, about 8 or 9 new initiatives that people have talked to me about, there wasn't too much of a larger dependence from the equity point of view on the foreign partner in any case, George. So to that extent, I would say it's a welcome one, and if after 5 years it does become in the normal course, like 74%, as it is for the other banking sector, other private sector banking companies, then to that extent, it's interesting. It's worth looking at more seriously and looking at some possible partners who can bring in the know-how and also the capital, George, which is the constraint of this guideline, basically.
Sure. But, Ashwin, on the one hand, you have the Finance Ministry saying that by not allowing corporates with interests in construction or real estate or broking, you are blocking people out who have the available capital to invest into the bank. That's what they're saying on the one hand. On the other hand, you've allowed up to 49% FDI, or rather foreign investment, in these new banks. So the capital is available. When you've allowed the foreign part, was there a need to go slow on, or rather make those relaxations for the construction sectors, for companies with the broking, with interest in broking, etc.?
You're absolutely right. George, there are 3 things about these guidelines. And if you read these 3 things together, then it does become a little challenging for the new banks. One is, of course, the FDI and the overall, not just the FDI, but also the foreign investment limits, on the foreign investment in a new licensed bank under the new guidelines. So that's one challenge. The second challenge is that these banks will not be able to take their equity perhaps may not be able to take their equity to the market because of the time it takes for them to take the equity to the market. In which case, the additional requirement will have to be really coming from the promoters themselves. And that's a very important point. I'm getting an impression, George, that that's what exactly, this is precisely what the regulator wants. He wants the promoter to really put in his name, put in his efforts, put in his capital, more importantly, work the bank for the next, for these 3-4 years, till it becomes invite domestic investors in to begin with, and after 5 years invite foreign investors thereafter, and open it up to both the sets of investors then thereafter.
Right. Hemendra, just bringing it back to you, what the RBI guideline says that the promoters will have to hold a minimum of 40% in the bank to start with, bring it down to 20% in 10 years and down to 15% in 12 years. But we've seen in the past that many of the promoters have been constrained in their ability to lower their stake for numerous reasons. Should we expect that that's likely going to be the same case over here as well?
See, we don't know that. Really, the RBI should have enforced that earlier guideline very strictly with these banks where the promoter stake, exceeded it. Unfortunately, it did not really strictly enforce that. So we have to really see whether the RBI will now enforce it with these new licenses as well. I think that we just have to monitor the RBI on this.
Right. All right, Hemendra, also the norm that they've said that independent directors need to constitute at least 50% of the board of the company. Would you say that that's easier said than done?
You see, this independent directors, are they really independent? On paper it looks very fair that, because in banks obviously the depositors have a much greater stake than the shareholders, and therefore to protect depositors' interest you probably want this from a corporate governance angle. But I think in Indian boards history has shown that in most of the cases the supposedly independent directors, they always go toe the line of the promoters. So on the face of it, yes, it will look very fair that there will be a lot of independence on these new bank boards, but in practice and given the way what we have seen so far, I think they will all be going in the same direction as the promoters.
Right, Hemendra, thanks very much for joining us on the phone line here, talking to us about your views, your perspective really on the new guidelines. And it will be interesting to see ultimately how many licenses are indeed issued. The applicants now have 4 months exactly, a little over 4 months really, to put in their applications for the licenses. So by on or before July 1st of this year is when they will have to submit their applications. We've been in conversation with Ashwin Parekh. Ashwin is of the view that you will see as many applications, as many applications as you did the last time. And all right, and Ashwin, again, I'm just going to ask you this thing again. This time around, should we expect that the applications will be far higher than the last time?
The number will be higher, but I am very confident. I mean, last time we saw almost 9 + 1, about 10 licenses being granted. I can't see 10 licenses being granted in this round. I can see about 4 or 5 at the most.
So Ashwin, Anirudh here from ET Now as well. I'd just like to understand what kind of entities would you actually be looking at which would be kind of applying for this banking license. We've seen a number of names come up in the past in the news, the likes of Tata Capital, Religare Enterprises. Would you have any shortlist in your mind as to which could be the best front runners at this point of time?
Well, I mean, I perhaps may not look at that. But I mean, I can certainly say who are the aspirants. I mean, I'm really for the purpose of my own, let's say, practice evaluation, I'm looking at it in 3 different segments. The pure NBFCs who already are into these kind of markets that we're talking about and who have a sizable portfolio, have a capability of running new banking with a very low cost structure, and therefore they become eligible. Some of them do become eligible. In the business houses, once again, very responsive business houses with huge names, with a lot of excellent, let's say, contribution to the economy will certainly come forward. They're really eligible. The economy needs them to really put good banks, So that's the second category. And you do have in the third category a number of professionals who may perhaps be able to find capital, and perhaps may work very closely with those who are in a position to invest and also to create, some kind of the third one, of course, if they do not have deep pockets, then they can find the whole thing very challenging. But in the first and the second segment, I would certainly see very interesting 3 to 4 replications per segment, I should say.
Right. Also, when the last time around, when we saw the draft guidelines come around, a number of people were expecting that the final guidelines could actually lead to some amount of M&A play really moving on in the banking sector as far as, the kind of guidelines that could be put out for the new banks. Do you expect any kind of M&A moving in from the side of the existing players as a result of these guidelines?
I don't think so. I mean, the banking that we are now talking about is going to be a different kind of banking. In fact, in that regard, I must admit, the object with which the entire exercise of issuing new bank licenses is being done, let's say, has been very well captured in the new guidelines. We're talking for different banking altogether. Is it going to really encourage M&A activity? I have my serious doubts, and the reason is very simple. To my mind, if there was some kind of an acquisition, it could perhaps be the acquisition of some of the NBFC units, which can become a part of the bank if they have a sizable presence in those markets where the regulator wants them to and the government wants them to go. So to that extent, there can be some M&A, but I'm not seeing too much of it, quite honestly.
Right. Also, if you look at the capital adequacy requirements laid out in these guidelines, they're saying that they should be at about 13% for the first 3 years of the operation of the bank. Do you think that this is something that the RBI has put out just to ensure that it is something that ensures that banks keep a lot of capital at hand in the very beginning of their operation?
Well, to begin with, I must say, and then this is one area where the Indian regulators really stand head and shoulders above the other regulators. When it has come to capital adequacy, is really, when the Basel norms were at 8% or at 8%, our regulators looked at 9%. The industry average today is around 12.5%, 13%. So therefore, for the new promoters to have that kind of cushion or solvency or capital base or adequacy base is not harsh at all to my mind on one side. It will also in some form, take away, in some, any discomfort that may arise out of cyclical conditions periodically. Lord forbid, and if one of the new banks were to face, some kind of an NPA of a size which can impact its, let's say, capital base, then to that extent some buffer is available, if you see my point.
Right, Ashwin, thanks very much for joining us on the show and so patiently staying on with us these last 45 minutes, walking us through many of those, the implications really of those guidelines for new applicants. We have also Mr. Bharat Doshi, who is Executive Director and Group Chief Financial Officer of Mahindra & Mahindra, joining us on the show. Mr. Doshi, firstly, thanks very much for taking time out to speak to us. The new guidelines are... You've made no secret about your intent on getting into the banking space, but the new guidelines in the form they are, would you say that the opportunity still looks attractive enough for M&M to be putting in an application for a bank?
Yeah, what I would like to emphasize and underline is that the new guidelines talk about rural branches. It talks about inclusiveness, and it talks about a sound credentials, integrity, and a successful track record. I think, therefore, Mahindra as a group would definitely be eligible, and that's what I'm delighted about. Now what we need to do is to study the fine print, to look at the transition provisions for an NBFC, because we already are in that space of NBFC where Mahindra & Mahindra Financial Services Limited is a very important player. So keeping that in mind, I would say that we will definitely look at this opportunity with great interest.
Sure, but I'm sure, Mr. Doshi, you wouldn't let the opportunity go, but do you believe that some of the guidelines laid down are rather stringent? Because one, of course, and we've been talking about this for quite some time now, is the fact that 25% of your branch network needs to be in rural areas, in unbanked rural areas with a population of less than 10,000. That's one. over and above that, you still need to adhere to the existing priority sector lending targets that are applicable to other private banks. Do you believe that is a little unfair?
Well, I would put it this way, that because we have a strong rural presence, we are better off than many others. And we already are in the priority sector lending area. So, becoming a bank, it would actually add further credentials for us.
Yeah, but Mr. Doshi, the question is, how present are you in unbanked rural centers with a population of less than 10,000? That's where the challenge comes in terms of your being able to actually make your networks in those your branches, in those centers work for you in terms of being profitable.
So, of course, there would be challenges while going on the way. But that's, while looking at any of those challenges, what I look at it from a very optimistic mindset is that we would be better than any other player, except what you call the existing players, and even the existing players in a way will be pushed to do the kind of branches in unbanked rural areas. So we'll look at that in that light.
Right, Mr. Doshi, this is Anirudh here from ET Now again.
Yes,
just like to understand, these guidelines in their form are not very different from the draft guidelines that have come out. Even you were also kind of eligible as per the draft guidelines. A number of
one was never sure, because it was being continuously debated whether industrial houses would be permitted or not. That was under debate. In the draft guidelines, it was not clear. So that is one major thing which is now clear.
Okay, so just like to understand if you had already started laying down any kind of a groundwork for moving your structure towards a non-operative holding company, or is it something that you're going to now look at doing following the application to the RBI?
Yeah, so either way we will have to pursue that following the application to RBI, because without the guidelines being there to take various steps, without being 100% sure what will be the structure, would also have meant a waste of energy and exercise.
Right. Stay on with us. We'll come back to you in just a moment. We have Mr. K.R. Kamath, who is chairman of the Indian Banks Association, now joining us on the show. Mr. Kamath, the final guidelines are out for new bank licenses. Your first impressions?
I think they are almost on the expected lines. I think the RBI has taken care to see that all those required precautions are taken. At the same time, there is an open space available to everybody.
Sure, but the fact that corporate houses with interests, irrespective of whether they have interest in construction or real estate or broking, all of them have still been allowed into this space. Is that something you'd have reservations with?
The question is that, see, there are very clear guidelines on lending to the promoter groups, which has been, I think, again reiterated today, that any board, any company, any bank cannot lend to the promoters groups. And there are very clear restrictions already existing. So it is not the question of what are the other activities of the promoters, but it is what the particular bank does. To that extent, I would say that there are sufficient safeguards on that.
Right. So, Mr. Kamath, do you believe that we have too few banks in India, or that we have too many banks in India? Because on the one hand, there are bankers who speak of the need for consolidation. On the other hand, there are those who speak of the need for more banks to coming in.
See, if 60% of the population is yet to have a bank account in this country, and after opening up the bank account, they need to get into so many other products, I think there is definitely a room for a few more banks.
Right. Mr. Doshi, if I could, bring it to you, and this is again something that we've been asking some of our previous commentators who've been coming in on the show. The requirement that the RBI has laid down of 50% or at a very minimum of the board needing to be independent directors, but the big concern among a lot of investors, institutional investors particularly, is how independent are independent directors?
Well, that's a separate subject of debate. I can tell you that the group, the Mahindra Group, and its track record on the independent directors, I don't think I should be talking about their names speak for themselves. So, and Mahindra Finance is a company where we have already 50% of the board as independent directors.
Right, Mr. Doshi, we'd also like to understand, given that there is a provision of having 49% foreign shareholding in the bank for the first 5 years, is that something that could be something that you could be looking at, bringing in a foreign partner to possibly, take part in your application for the new bank license?
Well, it would be premature for me to talk about that. One would definitely look at what the best structure is, but whether we need a partner to do inclusive work, we have been doing it in the non-banking financial services space independently anyway. So I just thought that I will underline that. Thank you. I will have to now disconnect.
What?
Mr. K.R. Kamath here again from the IBA. Mr. Kamath, if you could just outline for us, you've had a lot of discussions with the Reserve Bank as well regarding the new bank licenses. Have there been any key reservations that the banking sector itself had brought up which have or haven't been addressed in these guidelines?
I don't think that banking sector had any reservation on these things on giving the new banking licenses. We had only given some suggestions, and what guidelines which have come, I think have incorporated some of our suggestions.
Right, Mr. Doshi, if I could just bring it back to you. Now, we've lost. All right. Now, Mr. Kamath, this was a question from Mr. Doshi, but if I could bring it to you. Now, in the draft guidelines, the RBI had said that corporate houses, a bank may not be allowed to have the same name as a corporate house if it is backed or owned by it. Now, in the final guidelines, the guidelines are silent on that. We are assuming that they will be allowed to use their brands in the bank. Do you believe that if that were not the case, it would have proved to be a huge disincentive for corporates to want to get into banking?
Can you repeat your question?
Okay, so Mr. Kamath, in the draft guidelines, the RBI had said that banks will not be allowed to use the corporate brand name if it is backed or promoted by that particular corporate. In the final guidelines, the RBI is silent on that. We are assuming that they will be allowed to use the brand. Now, had that clause not been there, do you believe that corporates, this would have acted as a disincentive?
The question is that now that it has been allowed, why do we discuss on if it was not allowed, what will happen? It has been allowed, and I think probably the corporate houses will be in a position to leverage on their brands.
No, it's silent on that. We are assuming that it is being allowed.
What is that?
There is no mention of that in the final guidelines, so we are assuming that it is allowed.
Yeah, I see. That's what I was telling. I'm traveling in a car now. I was asked to immediately come online. I have not seen the full guidelines. So I go by whatever you have told me now. Since it is silent in the guidelines, final guidelines, I'm presuming that it is not there.
All right. Okay, so we have the final guidelines that have been put out by the Reserve Bank of India on new bank licenses. Now, just to run you through all of that once again, what it has said is there aren't too many changes from the earlier draft guidelines. So the initial capital requirement remains at 500 crores. As and when the bank requires additional capital and it needs to cross 1,000 crores, they will have to take the express approval of the Reserve Bank of India before they do so. Another requirement, of course, is that 50% of the board will have to comprise at the very minimum of independent directors. One of the key contentious issues within this whole thing was whether corporates with a presence in construction or real estate or broking services would be allowed into banking. To the extent that it is silent on that, and it has just said that corporates with a 10-year clean track record will be allowed in, we can assume that every corporate, irrespective of the space in which they operate, will be allowed to enter the banking space. So that's a big climb down on the part of the Reserve Bank of India. Remember, earlier they were insisting on that, and the governor himself had said clearly that for corporates to assume that the RBI will give any corporate a license is a wrong assumption to make. And so on that front, there's a big climb down. To begin with, a non-operative holding company, a non-operative financial holding company will have to be created. That non-operating financial holding company will have to hold a minimum of 40% in the bank, which will have to progressively be brought down, the shareholding of the promoters down to 15% within a period of 12 years. So these are some of the big key highlights, and also importantly, in the draft guidelines, the RBI was very clear that corporates will not be allowed to use their brand name on a bank should they be given a license. They've been silent on that front, so we can assume that corporates will be allowed to use the brand when they set up new banks. So that's again a big relaxation that the RBI has extended. So these are some of the key highlights of the final guidelines for bank licenses. I'm going to hand it back to Anirudh if he's been picking up something new.
George, whatever we've been picking up so far from the studio is basically that there is a lot of enthusiasm now within the corporate sector, given the fact that now that whole, the whole apprehension of whether corporates will be allowed to set up or whether they'll be expressly denied the opportunity to even apply for this particular license, all of that is now gone. So of course, all corporates who we've been speaking to, a number of them have really refused to come on air and speak to us, but clearly a number of them are very excited about the opportunity that they're going to get from here on. Of course, all of them are going to be sitting down, sitting with their legal teams, sitting with all of their financial teams to evaluate how these guidelines are actually going to play out in reality, and whether the opportunities of setting up a bank in this particular under these guidelines will really have key benefits for them. Remember, as you mentioned, there are expressive, they've really prohibited any kind of financial dealings between the corporate and the bank that's finally set up. Of course, so from that point of view, a corporate really doesn't have too much that they can really benefit from as far as setting up a bank is concerned. So clearly, it is something that the RBI is going to look at in a very granular manner. They're going to take a long time before they actually go ahead and put out those licenses. The final names, of course, it's going to possibly be very few names that finally do get it. George?
Right, Anirudh, thanks very much for taking us through that. So just to recap once again very quickly, these are the final guidelines put out by the Reserve Bank of India. License hopefuls will have to submit their application on or before the 1st of July 2013, which essentially means they have just a little over 4 months to put their business plans together and submit it to the Reserve Bank of India, post which at the first stage the applications will be screened by the Reserve Bank of India, after which the applications will be referred to a high-level advisory committee. The constitution of that committee will be announced shortly by the Reserve Bank of India. That committee in turn will submit its recommendations back to the Reserve Bank of India, and a decision on whether or not to issue an in-principle approval for setting up the bank will be taken by the RBI. The validity of the in-principle approval issued to the applicant will be for 1 year. And in order to ensure transparency, the names of the applicants will be placed on the Reserve Bank of India's website after the last date of receipt of applications, which essentially means that post July 1st, we will get a sense of which corporate houses have applied for licenses, and we will know how many have applied for bank licenses. But it's safe to assume, and going by past what we've seen in the past, that at best 4 to 5 licenses is what the Reserve Bank of India will issue. They will not want to issue many more licenses than that. So with that, we're going to end our coverage of the new bank guidelines, new bank license guidelines issued by the Reserve Bank of India. Thanks very much for watching. Thank you.